Hello once again. Guys, today we are on the third lesson of the trading program. Today we are going to be talking about pips, lot size, and profit, so that before you enter a trade, you already know what is happening. Now, at the end of this lesson, you will understand pip movement, understand lot size, understand pip movement, lot size, know the dollar value of every lot size, calculate profit and loss, and then control your risk correctly. Now let's dive in to the lesson. In Forex, the price that move in dollars, in Forex the price doesn't move in dollars directly. It moves in small units called pips, and your lot size determines how much money each pip is worth. Understanding this is the foundation of profit and risk control. Now, what is a pip? A pip is the standard unit of price movement in Forex. For most currency pairs, one pip is equal to 0.0001. So, for example, for the euro, one pip of this means that you are adding 1 to the to the fourth decimal place, and then 10 pips, 100 pips, in that order. So pip measures the distance the price moves. Now, what is the lot size? Let's move on to lot size. A lot is your trade size, position size. It determines how much money you gain or lose per pip. There are three main Forex lot sizes. We have the standard lot, the mini lot, and the micro lot. Now, this is the standard lot, mini lot, and then micro lot. Each represent how many currency units you control. Now, the dollar value of every lot size, for example, for the Euro USD, for pairs where USD is the core currency, like Euro USD, GBP USD, pip value is fixed. So for these pairs, the pip value is fixed. That is why I like trading them, because their pip values are fixed. They don't change. Now let's look at this table. On this table, we have the lot size, we have the unit controlled, and we have the price per pip. Now, this unit you control means that if you buy one lot of Euro USD, then you are buying this amount of pairs, or let's say this amount of euros. So you are buying 10,000 euros at that particular price. That is what it means. And with that, this is the amount that you'll be making per every pip movement, per every small movement, per every 1.0001 movement. You'll be making $10. That is if you are using a standard lot. Now, for the other lot sizes, like the 0.1 lot size, this is the amount of currency you bought, and per average 0, so let's say 1.001, you are making $1 per every movement. For the 0.01, which is the micro lot, this is the amount of currency you bought, and per every price increment, the pip per every pip movement, you are making $0.1. Now, these are the other lot sizes that we can consider as well, which is a 0.5. 0.5, you are buying five 50,000 units. That's 50,000 currencies, and then you are making $5 per every small price movement. The same goes for the rest. Now, this is why lot size is equal to profit speed. Now, the bigger your lot size, the more profit you make, and the bigger your lot size, the more losses you make. It's like buying rice at a price of, let's say, 5 CD, then all of a sudden price moves to, let's say, 20 CD. Now you are making some certain amount of profit, which is 15 cedis profit. That is the profit you are making. That is how the forex market works. Now, if you buy a currency and then the currency increases with time and then you sell it off, you are making a profit. So let's say if this was Ghana cedis, let's say if this was dollar, then you bought it $1 at 5 cedis, $1 at 5 cedis, then the dollar moves to $1 per 20 cedis, and then you sell it off, you are making a profit of 15 cedis. That is how the forex market works. Now let's move on. This is the profit formula. So at this point, the calculation is very simple. Now, profit is equal to pips times dollar per pip. Example, with one lot, 10 pip movement. So with every one lot size of trade you place, which is equal to 1.0000 units. Per every 10 pip movement, every 10 points movement, every 10 1.000, let's say 0.10 is equal to 10 times 100, which will 10 times, that will be 10 times 10, which will equate to 100. So this is the amount you're making, $100. Now, for the example 2, we have 0.1 lot, and with the 0.1 lot, fixing it into the formula, which is profit equal to pip times the amount per pip. So we do same for the rest. Now let's move to why lot size matters. Now this is the main reason why a lot of beginners blow their accounts. Beginners do not blow accounts because of pips. They blow accounts because the lot size is too large. Now, in trading, we don't treat it like a gamble. We treat it like a business. Now, if you have your $100 in your account and then you place a trade of one lot size, basically you are telling yourself that the money in your account, you don't want it because per one lot size, you know very well that, or maybe you are doing it out of ignorance, that every 1 point increment of a price or of a currency is equal to $10 loss or profit. So with just 10 pip movement, your $100 account is gone, negative. It's gone. Now this is a comparison between the lots sizes. Now this is the same trade but different lot sizes. Now for a standard lot, every 50 point movement, that's every 1.00, let's say 1.50 price movement is $500. So let's divide this into two. Now this is for the loss, this is for profit. So every 50 points movement in price, increase in price, is generating you either a profit of $500 or a loss of $500. That is for the standard lot, the one lot size. And the 0.1 lot also gives you either a loss of $50 or a profit of $50. Now the 0.01 either gives you a loss of $5 or a profit of $5. So in this case, with the $100 account, the trader is allowed to use only 0.01, because with the 0.01 is safe. 50 points is not small movement, it's a large movement, but you are losing $5. So that is why it is safe for beginners or even pro traders to use small lot sizes. Now we have a quick mental calculator here. So for USD code pairs that have USD in them, like XA USD, and then Euro USD, and the rest. This is how we calculate for them mentally. Now we are using one lot size, and then 0.1, and then 0.01. Now this is per every pip movement you are making $10 or you are losing $10. And then this with the 0.1, per every pip movement you are either making $1 or you are losing $1. And with the you are either making $0.1 or losing $0.1. So this is just how the formula is. This is how the formula is. So if you are using 0.3 lots, that means that per every price movement you are making $3. So for 25 pips you are making $75. 25 pips means 1.0025 increments in price. You are making $75. So we have come to the close of this lesson. You can please like and subscribe to this YouTube channel if you want more content, and then I'm going to be continuing to upload content like this until the end of the training session. And again, after the training session, a lot of strategies will be shared on this channel, and then a lot of signals and breakdowns and other steps as well will be shared on this YouTube channel. So do well to be part of it. Thank you very much for your time.